Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today we are talking with Mark Abel, who is a very switched on young fella, still in his late 20s with a portfolio of 6 properties. We're talking around about 64% loan to value ratio, and there's no sign of him stopping yet. He shares some insights into his upbringing from Mount Isa, where he had his old man as a bit of a financial mentor, his first couple of property purchases where he bought some fixer-uppers and did some renovations and equity uplifts, and also some of the low points where he had to sell his portfolio in order to grow because of cross-securitization issues with the broker setup. He answers some great questions about Townsville, which is his hometown at the moment, the lay of the land there and the opportunity for investors, and his advice on A-grade investment style assets and insights all and around that. It's an awesome interview with Mark, and here's Mark Abel from Abel Property Buyers. Mark Abel, thanks for joining me on Geared for Growth.
Thanks, Mike. Happy to be here, mate. Like I said, I'm a long-time listener, so it's great to be on the show and talk about property with you.
Well, that was a nice surprise because we did chat beforehand to get a bit of a brief of the show, and I appreciate the support. Don't always hear from the listeners, but it's amazing when you hear from people that have been listening for quite some time. Now, today is all about you, though. We want to talk about you and your portfolio journey, and you're very open in the success that you've had and some of the areas that you'll do differently. Take us back a little bit further to growing up in Mount Isa, which is a fairly remote part of the world, right?
Yeah, for sure. Mount Isa is a little town in northwest Queensland. I think the population, I haven't checked for a while, but about 20,000 people. So I was born there, grew up there, just doing all the sort of country town things you do as a kid. Went camping and rode motorbikes and fishing and played heaps of sport, and just loved it. Yeah, it was a great place to grow up. I was there till I was about 16. I think I left, and yeah, loved it. Little country town, and had a good time.
Now, apart from it being a nice sort of idyllic sounding upbringing for a kid, you also had your old man as a bit of a property mentor. Now, perhaps back then you weren't kind of necessarily thinking about your portfolio, but how did that kind of seep into your consciousness?
Yeah, Dad was always like sort of instilled an investor mindset in myself and my 2 brothers pretty early on. While we were in Mount Isa, he spent a lot of time renovating old unit blocks. So he'd buy these rundown sets of flats pretty cheap, fix them up himself, do most of the work himself with a few friends and other tradies and stuff, and then lease them out to the mines. And he built up a pretty decent portfolio doing that, and quite a good amount of cash flow over the years we were there. So he did really well, and just always instilled into us that just working at a job isn't enough to set yourself up for a good financial future. So yeah, he was always just teaching us about investing, and specifically property, and how property can really help you in the future and just give you freedom and choices and give you the option to really do what you want to do with your life. And unfortunately, due to some sort of rough circumstances about 2008, around when the GFC hit, along with some other things within his business, he ended up actually declaring bankruptcy and lost the properties and the portfolio that he'd built up throughout the time we're in the ISA. So that was a pretty eye-opening experience and a pretty tough experience on the family. But looking back on it, I learned a lot from that. And even Dad, he taught me a lot of lessons just from that experience about just being able to hold the properties and to maintain them through tough times. So yeah, it was a bit of a journey and a bit of an experience as a young kid, but yeah, a lot of lessons.
Yeah, I mean, that's great. Not everyone has the opportunity to have exposure to that kind of financial literacy kind of university of life stuff. There's a lot of people that argue about, we shouldn't be teaching Pythagorean theorem to kids because when are they ever going to use that? But there is a fairly strong argument to say that, financial literacy is not something that's really covered in school, but you got that extracurricular. So that's Great. Now, you left the ISA chasing a football dream and had a bit of a run there and a few issues with injuries and those sorts of things, but found yourself enlisting in the armed forces. Is that something that you always thought about?
A little bit. It was always sort of in the back of my mind to join the army. Moved to Brisbane just chasing a rugby league dream. Had a bit of a rough run with some injuries and stuff, and I kind of just lost interest in footy and wanted to just pursue other things. Decided to join the army. One of my best mates at the time was serving in the army, and he kind of talked me into it, I suppose. Just went down the path of enlisting, went through all my training. That was early 2017, I think. It took me into to signing up, and then ended up going through all the training down in New South Wales, and posted up to Townsville in that was late 2017, and where I still am at the moment. So, yeah.
But I notice for anyone watching on YouTube, you are not in your military uniform. You're in your Abel Property Buyers T-shirt. So obviously that was and gave you access to, what I assume is a reasonable income to start your property investing portfolio. And you bought up around that area. Tell us about that first acquisition.
Yeah, so I suppose property was always in the forefront of what I wanted to do from those lessons from my dad early on. So whilst I wanted to join the army, it was kind of always secondary to being a property investor. So I knew I wanted to buy property as soon as I could. And whilst I was doing my 6 months of training, about the 5th month, I found out that I'd be being posted up to Townsville. So I ended up buying a property in Charters Towers, which is a very small town, about 130 k's west of Townsville. Mum and dad were living there at the time, and they were looking for a place to live. And I was looking to invest. So I thought it'd be a great idea to buy an old rundown house there. And once I'm living up in Townsville on weekends and days off and stuff, dad and I could slowly fix the place up. And I didn't have much of a strategy per se. It was sort of just, I can buy something really, really cheap there, renovate, and I knew that would create some equity to allow me to buy more property. And that was really the whole strategy I had at that point. There wasn't much thought going into second and third and fourth properties, really.
And on the second and third ones, you stuck within that area, another property in Charters Towers, and then one in Townsville as well. How did you talk us through going from that first kind of fixer-upper that your parents were in and you were renovating to the next couple?
Yeah, so after we finished that renovation, I had quite a bit of equity, and I went to a mortgage broker who pretty much told me that I could buy more property, which is what I wanted to do. I didn't ask him too many questions about how, or specifically with structuring the loans, what sort of really what the equity release entailed and how it was all going to be set up. I just sort of thought, okay, I can buy more property, let's go. So ended up buying another one in Charters Towers, same strategy, just to renovate, create a bit more equity. And at the same time, I also needed a place to live in Townsville. So another rundown house in Townsville with the same sort of dad and I can fix it up. And I had a lot of mates with trade backgrounds. So just did it really, really cheap, got a lot of help and did a lot of the work myself along with, with dad and some friends, and ended up having 3 properties under my belt by, I think, the age of about 23 or 24 at that point.
Nice.
Yeah.
Very impressive. Now, are those results kind of, I mean, obviously it's a different age and time and, finances are different, but were those results kind of replicable for other people at the time, or did it really involve, the tradie connections, your old man doing the renos, you being quite handy yourself? Is that where most of the uplift came from, or do you think like even if you outsourced that to a reno company, they still would have stacked for you?
I think just due to how well I bought the properties, I bought them very well, like negotiated hard because I had to. I didn't have much savings or much backing behind me, so I really had to negotiate hard and buy really well. Obviously, doing a lot of the work yourself and doing it cheap really, really helps, and that allows you to to move quicker with the portfolio. But I think it would be replicable for people, but it just takes a lot of your own time. Like a lot of weekends that I spent just working, after work, Dad would come stay with me for a little bit, and there were nights where we'd be working till 9, 10 o'clock at night, tiling with floodlights in bathrooms and stuff. So
poor old Dad. Now beers are on you forever, right? Aren't they?
Yeah, 100%. I definitely wouldn't be where I am without him. He helped me out a lot in those early days for sure. But it's definitely is something that's replicable. It's just a difficult strategy and not a strategy that I would really recommend to people, especially early on in their investing careers.
For people that are looking at that sort of deal where they feel like they can buy something relatively cheaply and do a renovation where they're going to be, 2 or 3x their spend on the other end, what are you sort of looking for in those properties? Like, is it the kitchen and bathroom renovation, or ideally you avoid those big marquee upgrades and look for things where you can add value on the cheap with painting and maybe some landscaping and that sort of stuff?
Yeah, so we did bathrooms. That's definitely not something I'd recommend just because there's a lot of room for error there and costs can really blow out. But I think especially nowadays, I still like to buy properties that have that renovation potential, but more of a minor cosmetic. So as you said, internal paints, new blinds, floorings can be great as well. Even just refurbishing kitchens and bathrooms. You can do a lot fairly cheaply that has more of a bang for your buck, and you can get that 2-3x on your spend without having to use all your time doing bathrooms and placing kitchens and stuff like that. So yeah, that's what I look for these days.
So you had a couple in Charters, and we'll probably put Charters to the side because it is sort of quite a uniquely regional location, not exactly in the suburbs of Townsville. But I wanted to ask you about Townsville. Obviously, you lived there, you invested there, you were stationed there, you're still there today. And it's an area that has gotten quite a lot of interest. There's been some hotspotting style reports where they're putting Townsville on the radar, and there are certain pockets where you can still get in for a very reasonable price point when you compare it to other major locations around the country. Give us a bit of a lay of the land of Townsville. What are some of the tips and tricks for people to avoid or look to as a local? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, Townsville, I think, is a great option for investors at the moment, especially because of that affordability factor and the solid rental returns as well. So you can still buy here with a 4, a 4 in front of the number, which is great, which is kind of hard throughout a lot of other places in Australia. It is getting tougher though. Stock's getting really hard to find due to a lot of investors wanting to buy here, a lot of interstate migration as well. Open homes are really heating up. There's a lot of buyers, multiple offers on properties, so it's getting pretty tough. When investing in Townsville, you really need to be careful with your location specifically. Obviously, Townsville's very prone to cyclones and flooding, so it's really, really important to do your checks on that kind of thing. Also, I think it's getting tough now to just browse realestate.com and find a property and make an offer and expect to get your foot in the door that way. I think you really need to have some kind of, I suppose, network with an agent or possibly a buyer's agent just to give yourself an extra edge in the competition, because it is getting really, really tough here at the moment. Following on with that, there's expected to be, I think it was another 23,000 residents I read just the other day from Knight Frank, an article, by 2031. So population growth is really, really strong here. A lot of defence personnel, I think about 800 new Defence Force personnel moving up from Adelaide and across from Darwin. So there's a lot in the pipeline for Townsville, a lot of infrastructure spend. So I think it's a great spot for investors for the next 5 to 10 years even.
And it's warm, which is a bonus.
Sometimes too warm. Winter's great.
Yeah, right.
This time of year is beautiful. Just the summer can be harsh. Very, very warm, very humid. So
Yeah. Look, yeah, I guess I'm in the moment now where it's kind of like getting a bit crisp. I'm clinging on to the shorts and t-shirts. If there's a bit of a breeze, it's a bit rough. But yeah, I can imagine the wet season. It gets pretty humid up that way. Now, we're sort of at a point in your property investing career, I suppose, maybe a halfway point where you actually kind of realize that to get where you wanted to be, which was, a greater portfolio, there were some structural issues, and you referenced it ever so slightly when you sort of said to, with the broker, I didn't ask too many questions. Now, I'm guessing there's a story there that there were some questions you wished you would have asked.
definitely, yeah. At the time, I guess just due to being a little naive and a bit trigger happy, I just wanted, the equity release and wanted to buy and build the portfolio that way. And it wasn't until I sort of became more educated around financing and lending structures that I'd realized I'd gotten myself in a bit of a sticky situation where the 3 properties I had were cross securitized. So I'd kind of stuck myself essentially. And it came to a point where I had to really just look at my whole portfolio, reassess the entire, the 3 properties at that point. And I ended up making the decision to strategically sort of sell each of those properties within, the following 3 years, just to allow myself to restart essentially. So that's what I did. I sold all 3 properties over a period of, I think, 2 years, maybe 3. And 2021, I essentially, restarted and just built the portfolio up again from scratch with the knowledge that I had built up around financing. I'd also linked up with a mortgage broker who's investment savvy. He's built a pretty good portfolio himself, and that was a game changer, being able to just call him and speak to him and just really be educated, I suppose, around what I was doing. I had a clear strategy at that point, and I think, it was a mistake at the time, but I learned a lot from it and grew as an investor from it. So, it was a good experience.
There are investor savvy mortgage brokers, and then ones who don't necessarily own portfolios themselves. But you would think if someone's getting you investment property loans, they should kind of be across your strategy, or maybe forward thinking to surmise there might be a point in time where this is actually not the right strategy. Like, how do you kind of reconcile with that? Because I mean, that is a suboptimal position where you're forced really to sell and pay capital gains on these assets. Or, was it a blessing in disguise? Did you get better quality assets? Like, how do you kind of reconcile with that?
Yeah, look, I definitely see it as a blessing in disguise. I'm not one to sort of dwell on mistakes. Like, it's, it happened, it is what it is, and I learned a lot from it. And I think that's all that matters. As long as you learn and you can grow from those mistakes, I think it's a blessing. And from there, I was able to, fortunately, through the renovations, even after paying capital gains tax and your selling costs, I was able to profit quite a bit from the renos. And in early 2021, I sort of had enough capital where I could buy 2 reasonably priced properties on a 10% deposit. And I had a lot of serviceability, obviously, as well, after selling off those properties and clearing the debt. So no car loans, no credit cards, nothing like that, just a complete reset. And then, early 2021, I was able to buy 2 properties, within a couple of months of each other, just due to having the capital from those renos and a fresh portfolio, I suppose.
Now, they weren't in Charters Towers or Townsville, and they weren't indeed even close to each other. We're talking Ipswich, so just west of Brisbane, and then all the way across to Perth. So what made those areas kind of stick out for you as where the opportunities were?
Yeah, I sort of just I became really invested in learning about data in relation to property. And I started looking at different things like infrastructure projects and population growth and all the things I just spoke about with Townsville that make it a great investment spot at the moment. And just from narrowing down on locations, they're the 2 areas that I came across. And I knew that sort of diversifying between the 2 of them would be good for me. to spread that risk across 2 different locations. So that's basically how I came to Perth and Ipswich. So both have had really strong growth since then, and I think we'll continue to have pretty strong growth. They're hard areas to buy in at the moment as well. But at that point in time,
Perth especially, right?
For sure, yeah. At that point in time, it was a lot easier. Not as fierce competition, but yeah, from there, within 6 months, I was able to extract equity from the Ipswich property and buy another property again in 2021. So while I had to sell off the 3 properties, I sort of built it back to another 3 quite quickly, which was great. And from there, my financing was set up correctly, and I was able to move forward much quicker.
To the point where, catch us up to today, what does the portfolio look like? Because, after those 2, you continued to remain busy.
Yeah. I've always sort of just had the mindset of just continual accumulation. So now the portfolio is at 7 properties. So that's 6 investments and a PPOR here in Townsville with my wife. The total value at the moment is about 3.9 million, I believe. With total equity of about 1.3. So I think at 64% LVR last time I checked, something like that.
Yep.
And an average yield of about 7% across the portfolio, which is great. Which, in these interest rate times, it makes it a lot easier to hold the properties, which is something I learned from Dad early on, that being able to hold and maintain your assets is really, really important.
So across the board, are we sort of roughly positive or neutral or close?
Yeah, at the moment, pretty neutral, slightly positive. Obviously, with interest rates was affected the cash flow position pretty heavily. But
you go back, a year or 2 ago, and it's like rolling in cash, but now it's like, it just pays for itself. But with interest rates, the trajectory hopefully is down, and unfortunately, from a renter's point of view, there's nothing really pointing to a respite in the rental growth, which investors are the beneficiary of. So, and you're still, that LVR, I think it's important to put that in the context of where you are in the cycle as well. You're still a young man. You're still probably in the accumulation phase. So, if you were in your 60s, that LVR, you might kind of think that's a little bit high, but that's actually really quite good at where you are at the moment, right?
Yeah, for sure. I'm definitely happy with the position I've gotten to now. Obviously, I want to keep building. I want to try to inject a couple of cash flow deals into the portfolio. I'm looking at building a granny flat on one of the WA properties, and then potentially look to add in a unit block or something like that, just to up the cash flow position a bit more. But these days I'm pretty invested in the business side of things as well, Abel Property Buyers. So that's something that I've started recently, which has been great. Being able to help people buy property and invest and create sort of the freedom for themselves and the I guess security around having a portfolio that I've been able to achieve. So that's something I'm really passionate about now as well, along with the portfolio, of course.
Yeah, awesome. And the people that are coming to you, I'm interested in what they are trying to achieve. Like, do people come to the idea of like, I actually want to create financial freedom and security, or they're just kind of thinking, I want to get an investment property because that sort of seems like the sensible grown-up financial thing to do?
Yeah, I think for a lot of people that I've spoken with, it's more just they don't want to work till they're 60. People are, I guess, wiser to the fact that they can shorten the amount of time they need to spend working, even just by buying 1, 2, 3 properties can make a big difference, which is really achievable for people over a period of, 10, 15, even 20 years. It's very, very achievable, and you can shave a lot of time off how long you need to be working and earning an income that way, just by getting into the market early, buying well, holding the assets, and building yourself a portfolio and a bit of a nest egg for retirement, I suppose.
Now, removing the sort of cross-collateralization issue, what are some of the areas that you would sort of rate yourself and your journey as, this is actually good, this is a smart move, and what do you think are some of the learnings that you're able to share with your clients at the moment?
Yeah, I think education was probably the biggest thing. I think the fact that I got myself into that position, it was really just a lack of being educated. there's so much free information out there today with YouTube and podcasts that I just consumed as much as I could. Every time I was in a car or at the gym, I was listening to podcasts or watching YouTube videos. I spent quite a bit of money on property courses and different courses relating to data around property. So I think the biggest thing is education, and second to that or on par with that is building a team of professionals around you. So like your accountants, quantity surveyors, good one to have on your team, I suppose. And,
what do you mean you suppose? Come on, we're person number one. Yeah. Like, I mean, yeah, it's funny, like with a team, like a quantity surveyor, you tend not to bring along with you for the journey, right? But it's one of those services that all investors really need to plug into, right?
For sure. Like, without giving you too much of a plug, Mike, it's definitely something that's underutilized is quantity surveyors. That it makes a massive difference when you've got a few properties under your belt in a portfolio. So yeah, along with that, having a good team of property managers in the areas that you're buying in, buyer's agents if you choose to use a buyer's agent. So those would be the biggest things. Also, just something that I think is overlooked is keeping yourself appealing to lenders from a serviceability perspective. So, keeping away from credit cards where you can, and car loans and discretionary spending. That's something I've always been really big on, is just keeping that spending down, staying away from the bad debt, and just always being in a position where, I guess the lender will look favorably upon you when you're going for pre-approvals and loan applications.
Yeah, absolutely. That's super important, especially if you want to get to a portfolio like yours. Eventually it becomes a game of finance and tipping the bank upside down to see what they've got in their pocket to lend you. Before we finish, I want to get a bit of an insight into, obviously with your experience, what your take on a blue chip sort of investment grade asset. Blue chip's probably not the right word, but I just mean like a bread and butter. This, I think, is actually a great type of property for new investors, or just something that's a real easy addition to a portfolio. What does that kind of look like to you in terms of locations or houses versus units and yields and price points and those sorts of things?
Yeah, I'm definitely established houses is what I've always bought and what I'll always buy and advise my clients to buy. So I like established houses on, sort of a minimum 500 to 600 square meter parcel of land. So I like the land content for sure. Houses that are, low set, solid brick homes that are, lower maintenance, that might be slightly outdated, where you can add a bit of value through a cosmetic reno. That's what I like to look for in locations that are sort of posed to have strong capital growth. But along with that, three things I sort of always say to people when they're looking to invest is to make sure, yes, you've found the area you want to buy and it's a good location, but you need to buy well and try to buy below market value. And then if you can force a bit of value through a cosmetic reno, that's how you can really accelerate building a portfolio, because you're able to extract your equity quicker and essentially pull out your entire deposit and the money you've spent on the renovations. In some cases, sometimes within 6 months, you can withdraw that equity again and start looking for the next deal. So I think those are three really big things that will help people accelerate the portfolio, because, it may just be me, but I don't want to spend 15 years building a portfolio when I can do it much faster and get myself to a better position passive income wise within, 5 years or 10 years. So I'm looking at doing things really quickly and accelerating the growth of the portfolio pretty rapidly. And I think it can be done still, even in today's times with interest rates and the way they are. So, yeah.
Beautiful. I love that. Great advice. Now, Mark, if people are wanting to get in touch with you, what's the best way to do that?
Yeah, so they can jump on the website, abelpropertybuyers.com.au. From there, you can book in a call with us. Failing that, you can jump on Instagram and Facebook, Abel Property Buyers. Just send me a message. I'm always happy to talk with people just casually, on Instagram. I get a few DMs from people just wanting some info about property and where to buy or what they should be doing. So, yeah, always happy to talk property with anybody who's interested.
Awesome. Well, Mark, we appreciate your being so open with your journey, the success and the failures alike. It's been awesome and some great advice. Thanks for joining us.
Thanks, Mike. Appreciate your time as always, mate.
Cheers.